Right. Welcome to International Finance. Today, we are starting off with this question 6 here from October, November 2021. Right. So it was analyze the exchange rate risks that may arise in international transactions and examine how these can be covered or hedged. Right. So this was 20 marks. Very interesting. How I would hope we get a question like this for a whole bunch of 20 marks. Okay, so I think I did make some notes on this, and the notes are actually a lot more perfect than what we are going to be discussing here tonight. They actually give more detail into what we are talking about here. But I think it's that part of the module where I was saying, where we deal with quite a lot of definitions there and brief explanations. So in this particular question, you want to analyze the exchange rate risk, of which there are three types that we want to look at there. And then obviously that may arise as a result of international transactions. So we would normally refer to this as just what are the exchange risks. They could have phrased that question that way. And then then thereafter we look at how that can be covered. So all of that is in the notes, right? But just to give you a recap on that, I don't really have the notes on that, right? Handy. Let me see. I don't think I have the notes on that handy, but I'll think about what I can fetch out of my head. So if you do have somewhere to write, then maybe you can write on the side, or if you're later going to refer to the notes, that would even be better. All right. So basically, you start off with these kind of questions. You want to start off by giving an overview of what exchange rate risks are, right? Which we normally refer to as foreign currency risks or currency risks, as you might want to say, or foreign exchange risks, right? So these obviously you want to explain that why they arise or how they arise. So they obviously arise as a result of changes or fluctuations in the exchange rate. So you remember what an exchange rate is: the price of one currency in terms of another, or in terms of another. So whenever there is a change in that exchange rate, inherent to that is foreign currency risk, right? So they obviously impact, they could impact you, impact organizations, as anyone that wishes to engage in any transaction that makes use of foreign currency. It obviously gets impacted by these fluctuations, right? So this is more like the price of the currency. It's like general prices, right? Because remember, foreign currency is also a commodity. So if you are dealing with a commodity whose price keeps changing, you can imagine the impact of that. Yeah. So what are those risks now? So they are classified, or they are basically separated into three, right? There are three classifications of that. So number one is transaction risk, and then we have the other one, translation risk, and I think the third one should be economic risk. Those three. So you should look that up on the notes. Yeah. But generally speaking, whenever we talk of transaction risks, we are obviously referring to a situation where a company has gotten into a contract, right? And then that contract is at a certain, or that contract is arrived at a certain date, right? But then the settlement date is a different date, right? So it's like you could get into a transaction where you buy or sell something at a certain date. So remember, transaction date is basically the contract date, right? But the settlement date, if the settlement date is not the same as the transaction date, there is a risk now between those dates that sometimes the foreign currency might change, right? For instance, if you have entered into a debt transaction, right, where you need to pay off a certain amount, what happens if that, for instance, if that amount is denominated in a foreign currency or in foreign currency, what happens when you have to settle the amount and the rate has changed unfavorable? So that's what we are talking about. So in transaction, we are basically looking at the difference between the contract date and the settlement date, right? So whenever the possibility of having fluctuations in exchange rates between the transaction date and the settlement date, that's what would basically refer to as the transaction risk, right? And then the translation risk, on the other hand, deals with a situation where you are a huge company, and then as a huge company, let's say you are a transnational company, you've got subsidiaries in different countries, right? So of which, according to the accounting standards, they will have to present their financial statements there in those different countries, denominated in the local currency there. So when you need to translate now and when you have to consolidate those statements, the value of your company is going to be affected by the prevailing exchange rate on that time. For instance, if we have got, right now, the rand has been falling, right? So if we have got, let's say, a company that's based in the United States, and that company is a subsidiary of our company, and we are here, our head office is here, the head company is here, right? What happens if now the rand is depreciating against the dollar? The effect of that on the balance sheet, on the financial statements, would be that the company is going to appear a little bit more profitable, right? Not as a result of, not because of the company doing well or stuff like that, but it's merely because of the exchange rate, the favorable exchange rate. So the exchange rate will be favorable for the company that is in the US. So when we consolidate now, the value of the company as a whole seemingly has gone up. But that can obviously occur also the other way around. So if there's a depreciation in that currency, the value of those assets is also going to go down, right? And then the third one was economic risk. So when we talk of economic risk, we are looking at the company's exposure, right? How the company's cash flows and profitability is basically exposed, right? Or prone or vulnerable to exchange rate movements, right? So obviously this would work when a company has got cash flows that are coming in different currencies. So obviously in those instances, there's gonna be an effect there, right? So it might appear higher, it might appear lower, right? As a result of those changes. So just do check the notes regarding the exchange rate risk. So those three there. And then what strategies now could you come up with to cover those? They're saying examine how these risks can be covered or can be hedged, right? So in terms of hedging, we are talking about how you can cover yourself against that. So we dealt with those again on the notes. So you're basically looking at the forward contracts. Maybe you want to look at futures, currency options, maybe money market hedges and stuff like that. Diversification also could come in there, right? So we'll see if we get a question like that, how many we would be able to remember, right? But forward contracts, right? Forward contracts are the more common ones, right? They are the more common ones. It's where you basically enter into an agreement with a bank where you buy or you lock a rate, right? You basically buy a rate from the bank. For instance, it could either be at a premium or at a discount, right? Depending on what the expectations are in terms of the rate. So the bank doesn't want to lose, right? So this is a contract where you're saying in 3 years' time or in 6 months, it's not 3 years, sorry, in 3 months' time or in 6 months' time, you are going to go to the bank and perhaps buy a certain amount of foreign currency, right? Or you are going to require a certain amount of foreign currency, or it could be the other way around where you are saying at a certain amount, let's say a company in the UK is going to pay you in 3 months' time, and then you want to have that surety of the amount, you can then buy a forward contract with the bank where you say, this is how much the bank is going to exchange your pounds to rands. You see, so you basically lock that rate at that amount. So whatever happens, should the rates increase or decrease, you're not going to be affected anymore. So in most cases, what you will be scared of is let's say a company in the UK needs to pay you in 3 months' time. You are basically going to be afraid of a situation where the value of the pound depreciates, right? If the value of the pound depreciates against the rand. So it basically means that in terms of rands, the money that they're going to be paying me is going to be a lot less than what it could have been, right, had the pound not depreciated. So if it appreciates, fine, it's a foregone opportunity now. Right? You could have gotten more, but it's unfortunate that you would have locked up that in a forward contract. Right. Then the other one was currency options. So with foreign currency options, you also want to know the difference between options and futures. So that was highlighted again on the notes. Right. So foreign currency options, these ones will provide you a right, right, but not an obligation. It's a right to exchange a currency at a predetermined date. Right. So it gives you that kind of right there. And then futures are normally standardized agreements to buy or sell a specified amount of, say, a certain amount of pounds of foreign currency at a predetermined price and on a specific future date. So just check on the notes again. I think I did highlight the differences between those two because there is a tendency with our examiners to actually ask the differences between currency options and future contracts. So which we normally just refer to as futures, right? And then money market hedges also. Money market hedges. These ones here, okay. I think they normally go into detail with these ones when you are now doing when you're now maybe doing your postgrad and what have you. But what I would say about that in terms of money market hedges, you might want to maybe borrow or invest in a certain currency, right, to try and offset an exchange rate risk, right? So you're actually in your quest to try and offset a risk, a foreign currency risk, you want to invest maybe in that other foreign currency so that you can match the cash flows. For example, let's say you are, let's just say you are owing an amount that is denominated, say, in the US dollar. Like you already owe that amount. Maybe you can invest in an asset that's denominated in the US dollar so that you can match your inflows and your outflows. Right. So this is similar to, it's not exactly the same thing, but it's similar to what we call foreign currency swaps, right? Which also work again in terms of hedges, right? Or interest swaps, right? Whereby, let's say we have a company that's in, right? We are a company that's listed in the JSE. We are a South African company. Our head office is here. Now we've borrowed money from a bank that's in the US, and we also have a subsidiary that's in the US, which has, let's say, borrowed money from a South African bank. So we can simply swap the interest rate there, or the interest. So we are paying the interest that's due to the South African bank while they are paying the interest that's due to the American bank. So that's how that could work out. And then, of course, diversification. This is very similar again to diversification, but except that in diversification, you want to be operating in multiple markets, right? Just so you can offset. When the rand is depreciating, it's not like the dollar is depreciating or the pound is depreciating. So in that instance, all your losses and gains are going to offset each other, right? That's the one advantage of that there. So just check on the notes on that and then see how you can maybe explain it in your own words, right? And using examples that you think are going to be unique there. Strange, you wouldn't really quite expect a question in that manner for like 20 marks, but it would really be a dead giveaway on that question. Right? But let's see what was in 2019. Right? Let's see What was in 2018 and 2019? All right. Name and explain the terms of, the items of the financial account of the South African balance of payments. So I did indicate that they normally want to ask you about everything that's in the South African balance of payments, but they could as well ask you to name all the items. So maybe on the static guide here, the textbook is not exactly going to give you something that is specific to the South African balance of payments, but the notes, as well as I think on the notes, there's stuff that I left out, but it was not on the financial account, right? Probably one of those things like unrecorded items or reserves, maybe. I think that's one thing that I left out there. But here, this one, you have everything here on the note. So you are simply, I think it's named and explained there, right? Where you're looking at foreign direct investment, etc. So those are the ones that you are basically listing there and then coming up with a brief explanation. So this would be fairly easy there. But while at it on the note, do check maybe in the current account as well, because they could just twist this question. So they haven't asked this, I think, since 2018. So we need to be on the lookout for a question like that. Right. Caitlin, yeah, can you unmute yourself just a second? I need to ask something. Or maybe I just hope she's not in a noisy place. Miss Brits, okay. Now, how are you doing? Can you hear me? Hello, hello. Okay, no, she's not here. Okay, she's not here. Right, it's fine. It's okay. Right. Discuss dollarization as well as associated costs and benefits of that. So we also had a lengthy discussion on this. But we also had a lengthy discussion on this. Maybe if you have time, we can as well look this up on the previous videos. But this is where I was giving an example. Sometimes it would become, it's not okay. She's saying, oh, okay, that's fine. All right. Sometimes, okay, dollarization would specifically refer to a situation where one country is adopting another country's currency, right, in full, another country's currency in full. So this is not the same as, sometimes there can be a multi-currency system operating in the same country. I remember in Zambia, some years back, because of hyperinflation in Zambia, that time the kwacha wasn't doing well. Right now, it's actually doing fairly well, I must say. It was stronger than the rand not so long ago. So it's doing fairly well now. So the kwacha was doing so bad, and then they ended up introducing the dollar. But the thing is, the dollar was running concurrently with the kwacha. So we wouldn't exactly call that dollarization, because in dollarization, you're looking at a situation where the currency is completely replaced, right? So that would constitute dollarization. So in terms of what was happening in countries like Zambia and Zimbabwe, that would simply be a market. But
Hi, can you hear me now?
Yes, we can hear you now. I was saying
It's a
you
struggle
you
here
had
on my
promised,
end, sorry.
okay. You had promised to send some stuff in the group. You haven't sent it, ne?
Yeah, I've been busy. I am gonna send it. I haven't forgotten yet.
No
And
problem.
this question is one of the questions that she said it's gonna be potential questions that's gonna be in the exam.
Mm.
The advantages and disadvantages of dollarization.
Okay,
The
that's
one that
that
you're
would be
doing now.
this one here. Can you read Afrikaans?
Yeah, my home language is Afrikaans.
Or is it okay? Just out of
Yeah,
interest, before we let you go, how would you read this one here? Just out of interest. I can't speak Afrikaans, so I would be
okay.
interested to hear it.
Okay, bespreek dollarisering as ook die koste en voordele daaraan verbonde.
Okay, okay. That's very interesting. Actually, okay. At least it's a translation of this, so I can get what you're saying, but I have I have no idea.
Yeah, but the
Thank you
Afrikaans
so much.
version, it's much difficult, like the words.
Yeah, yeah.
I answer most of the questions in English because
Hmm.
the words are not exactly the same in Afrikaans. Yeah.
But don't you think the markers would be more lenient if you answer it in Afrikaans? Haven't you thought of that?
Oh, I think I would fail if
Oh,
I
if you
answer
wrote
it
it
in
in Afrikaans.
Afrikaans. Oh my word, no. Afrikaans is it's some people think it's very easy because it's our home language, but
Mm.
it's not that easy, yeah. Especially certain words. It's not the exact same like the English ones.
Okay.
Especially with the economic terms, yeah. The
Hmm.
definitions are not exactly the same. You think it's gonna be the same, but actually it's not like the same.
Then that
Yeah,
can
so I
actually.
think I would rather take my chances in English than in Afrikaans.
Okay, no, that's fine. All right, so back on this one now, what would be the associated costs and benefits? So I think on the lengthy discussion that we had on this, sometimes maybe we need to think of this in terms of a country's sovereignty. So I'm not really going to go into much detail because I think we do have these notes and it's easy to get this right. Maybe what will be difficult is identifying what dollarization is and what is not dollarization, right? And then obviously associated costs and benefits are just like she said, advantages and disadvantages. So the
Mm,
one major advantage that maybe we can think of here is the circumstances under which you go into dollarization is when your own economy is in distress, the financial sector is in distress, your own currency is failing. Right? So that would be a quick way of boosting, bringing stability into the country. So when the money is going down, when there is hyperinflation and what have you, it's easier for you to jump to another currency that is more trusted than the currency that you are the ones that are using, the currency that is being used. So if the rand keeps falling and eggs are becoming expensive, like what's going on now, maybe we might consider dollarization, right? Because we know that if an egg is, let's say, if a tray, 6 eggs, it's about $1. So if it's $1, it's $1. It will always be $1, right? That's one thing that would be an advantage there in terms of stabilizing the country. Then the major disadvantage, we look at this in terms of the country's sovereignty and the integrity of the reserve bank. Why would you have a reserve bank that cannot print money, that cannot be the lender of last resort? You see, because now basically we now have to depend on, if it's the United States dollar, and then you're gonna be dependent on the federal bank, right? The central bank of the United States. So which means whatever, we can't come up with policies of our own. We can't have an expansionary monetary policy, neither can we have a contractionary monetary policy to try and fix our own home issues. That would be very difficult to do, you see. So, but given that it's 10 marks, there really shouldn't be anything. Maybe I think you could as well come up with four points there after describing what dollarization is. That should pretty
yeah.
much do it.
Be-
Mm.
Before you move on to the next one,
Okay.
can I mention something quickly? Yeah, on my notes.
Yes.
So she said, can you scroll up quickly?
Let me go back. All right. What did she
Sorry.
say?
Okay, so you said it's 10 marks, eh?
Yeah.
So you're gonna, like you said, 4-4.
Yeah,
For
in
the
terms of,
cost,
so
yeah, for the cost.
advantage and okay.
Can you hear me?
Yes, perfect. So I was moving around looking for a charger, but I'm listening.
Okay, so it's 10 marks. So then 4
Yeah.
marks is gonna go. I'm just making an example like she used.
Mhm.
4 marks is gonna go for the cost and then for the benefits as well. And then
Mhm.
for discussing the like defining the concept dollarization,
Mhm.
that's a mark as well. And then the last mark is for
Mhm.
an example of dollarization. So you have to give like
Mhm.
a country that yeah, you have to give the same with dollarization, and then with currency
Mhm.
board agreement, you have to give an example on both ends.
Of what
With
country?
yeah, with the discussion of the dollarization and then the cost and the benefits to obtain the full 10
Mhm.
marks.
Mhm.
Yeah. But I'm gonna send the notes.
Please do.
Yeah.
Please do. All right. So this was still on the 2018. Illustrate with the aid of a diagram, use aggregate demand and aggregate supply curves, how the government can use fiscal and monetary policy to stimulate economic growth. So this one is a lot simpler, né? I think we didn't even draw these graphs, did we? I don't think we did even draw these graphs. They are pretty straightforward there. Right, how can domestic absorption fall automatically as a result of a depreciation in currency, in domestic depreciation of the domestic currency? Right. So here, what is domestic absorption? Right. I think we were not talking about this yesterday. I think we were talking about on the Swan diagram, we're talking about domestic absorption, right, which was on the x-axis. So domestic absorption is basically, when you refer to domestic absorption, you're basically dealing with, in other words, it will be domestic consumption or domestic demand, right? That's what you were basically dealing with there. So how can domestic absorption fall automatically as a result of a depreciation in the foreign currency? So what we would basically be trying to explain here is, maybe if you like, you can start off by talking about what domestic absorption refers to, and then what is a depreciation in the domestic currency, so which is a fall in the value of the domestic currency, and what the implications of this are in terms of domestic absorption. So these are the implications. Having defined what your domestic absorption is, you can then go on to state the mere fact that you can then go on to state the mere fact that part of domestic absorption falls on part of domestic absorption falls on international products, which is imports. Right? We need to buy some of those products from abroad. So, which means if there's a depreciation in the currency, it basically means that the value of this currency in terms of another has depreciated, right? It has basically gone low. So things that are denominated in foreign currency are going to be more expensive, right? So which is how now um, we can bring in maybe the law of demand. That's the higher the price, the lesser the demand. So because the price is now higher, we don't exactly expect demand to continue thriving, to continue going high. So there's going to be a fall in that demand. So this is what we are basically talking about there. So it's only 7 marks, so nothing much on that. So maybe it's just a manner in which we need to convince the markers that, okay, we understand these terms that they are talking about and the implications, how these two link up, right? In terms of domestic absorption um, as well as a falling domestic currency, or depreciating domestic currency, right? So this is illustrated, of course, on the Swan diagram. It can be illustrated on the Swan diagram, but because we are only looking at just one specific part here, there's no need to talk about the Swan diagram. And looking at the mark allocations, there's no need to talk about that. They're pretty straightforward. Then How many hours is the paper, by the way? Is it still 2 hours? I can't remember. Maybe it's I think it's 2 hours. No? All right. Illustrate and briefly explain with the aid of a diagram the process of correcting a deficit in a nation's balance of payments by devaluing. So in your answer, refer to the importance of elasticity of
3 hours.
elasticity. 2 hours. Okay. So we are illustrating here with the aid of a diagram the process of correcting a deficit in a nation's balance of payments through devaluation. Then in the answer, refer to the importance of elasticity of the applicable supply and demand curves. So this is the instance now where we need to put in those two curves. Right. Let me see. I'm not going to be able to draw this well on Zoom. And by the way, they stole my drawing board. I used to have a drawing board. Okay, let me pull this over here. Right,
How can someone steal your drawing board? Who's stole
it's here. It was in my bag, and they took the whole bag with the other laptop that I have.
Oh, oh.
I
Hi,
was,
that's
I,
unfortunate, eh?
yes, I was in Johannesburg, so you could expect that here.
Yeah, you could expect that there.
So if any of you guys were hoping to visit Johannesburg, please be warned.
Oh, no, I won't.
It's not a friendly place.
I'm not for the city life. I'm a farm girl.
Oh, that's nice, actually.
Yeah.
If I had money as well, I would be in the farms, by the way. All right, so maybe how we can do this. Ne? Okay, let's see how good I can be able to draw this one here. Okay, now we don't want a straight line. Ne? Okay, still a straight line. Mm, all right, just give me a second. Now I'm failing to get the right line. Okay.
When we draw a graph on the word,
Mhm.
can we use this exact option like you're doing now, or isn't this available on Word? Because I'm considering to type the
Mhm.
exam rather than,
I think if you type the exam, try
but
and
look at the
hand
graph.
draw this.
It's not looking like.
You see how it is.
Yeah, that's why I'm understanding now why you're saying it's better to hand writing
Mhm.
to, yeah. It's not looking at exactly the same.
Yes. You know what I did in one exam? The thing is, I usually do it fast, so I have a lot of time to draw these things on 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 Microsoft Word. I usually have that kind of time, but that particular day, I started off quite late. Right? I started quite late, so I ended up being under pressure, so I had to end up hand drawing as well. Because once you are not hand drawing, if you make a mistake, you need to keep canceling, and that time is
Mm,
not on your side. You see,
it's also time consuming, yeah.
very much time consuming.
Mm-hmm.
So it's not helpful in terms of assisting you. If
Because
you
there was
start
a
with,
few students who send tutorials, videos in the
mm,
group on Telegram.
mm,
They downloaded it on YouTube how to
mhm,
draw the graphs on Word. But
mm.
I'm not a tech guru, so I don't know how to.
It will waste your time, that one, in an
Waste
exam.
time, yeah. I think students who have like an advantage when it comes to the PC and has like knowledge with it,
Mm.
it's gonna be beneficial to them because they know it at heart. But me,
But But the problem is, again, it's not like it's going to give you more marks if you do that.
Mm.
And if it's curves, it's worse.
I just hope it's not a strict examiner because I just wish that lady could mark our scripts, not someone else.
Nah, but she
She's
will,
not
I'm
that
sure.
harsh. She's not that harsh.
This is a D. No, I'm trying to make this appear properly. But I think you remember this graph. You guys drew this graph before, but it looked pretty much like this, a little
Yeah.
bit more. Right, let's just say the currency. Okay, so the point there that was being made on that graph now is, okay, this is the point of equilibrium, and that one there is the point of equilibrium. So in terms of elasticities, what they are talking about here, in terms of elasticities, we are making reference to the different gradients of these lines, right? If you look at the demand curve here and the other demand curve, this one is more elastic than that one, right? And then again, if you look at the supply curve, this one is more elastic than that one. So at a point, suppose we are starting off at this point, right? We are starting off at such a point here, right? Which is below, can be at that point and that point. Though ideally, let me make them coincide. Ne? Okay, it's not working out. But you can make them meet up, but you don't really have to make them meet up because the bottom line is that both of these it's a deficit, right? Which is what we are trying to eliminate there. We are trying to correct a deficit. So a deficit would occur at this point. Why? Because we're saying the demand of foreign currency is greater than the supply of foreign currency. So which means this should mean that we are importing more than we are exporting. So any point that lies below the equilibrium represents a deficit. Right? So what you do there to eliminate that, then you need to depreciate the currency. Right? So a depreciation is a movement upwards there. So as you are depreciating the currency, there's a movement along the curves there. Right? Then where the issue of elasticity is now come into play, where they become relevant, it's the question of by how much do you depreciate the currency. So with the first one here, with the first S, you can see that the movement is not a big movement. You're simply moving from there to achieve that. So you don't really need a big currency devaluation. But for the steeper graphs now, you need a bigger devaluation for you to get right to the top there. So that's what would basically be illustrating. So this will be free, totally free, 17 marks. Once you are able to draw this one here and then you put in numbers that you can at least understand, right? Numbers that you can at least understand. If you look at the one that's in the textbook, the numbers are quite clear there. They will give you numbers like, let's say this is 3 there, right? If the currency price is 3 there, they could then maybe give you, what would they give you there? What is 100% devaluation of 3 will take us to what? Would basically take us to 6 there, right? It will take us to 6 there. And then maybe they could put a 9 there again so that you can be explaining in terms of a certain percentage of devaluation for the first part can actually take us from a deficit right up to a balance or an equilibrium there. But it wouldn't work for the next one because we would need to depreciate it a little bit more. So that would work like that. So I'll be happy if this one comes out because I think I remember you guys drawing this graph. So I'll be very, very excited on this one. So which means what you'd basically be doing is comparing our stuff, right? So just make sure if you have the textbook close by and you can easily get a hold of some of these graphs, just change also, right? And see what you can change there. Right. Discuss the reasons why absolute purchasing power parity theory could be misleading. So here we are simply talking about why the absolute purchasing power parity theory does not work. So I think we were on this again yesterday when we were leading to the determinants of what were we doing, by the way? Trying to determine the exchange rates, right? And we are specifically looking at those four things. The first one was this one here, absolute purchasing power parity theory. Let me just, I just need to grab a charger here. I just need to grab a charger here. Just a second. All right, before the phone goes off. All right, my bad. Right, I made it in time. So that's all there is there on that one. So I think the notes are there again on absolute purchasing power parity theory. The question could also be on the relative purchasing power parity theory. So that could pretty much work there as well. So you can just apply that on that one. So sometimes the wording maybe could be tricky, but look, you just need to understand what they mean there, right? Okay, the paper is 3 hours from 8 until 11. Yeah, that's a lot of time. Does it include submission time?
Yeah, that's the thing. The submission is separate.
Okay, that's fine.
They
Which one is
extended
yours?
it from half an hour to an hour now. That's what I've
They
read.
did well. They
Or if they
did
change
well.
it, because with the lectures, they always change the stuff. So I think we need to confirm like a day before the
Please.
important aspects of the exam, yeah, before we just assuming like the time frame that we have to write. We just need
Yes,
confirmation. Yeah.
perfect. All right. This one, you hardly ever get these questions here, but C is equal to 100 plus 0.8y and autonomous investment is 100. Try and explain a figure showing the equilibrium level of national income. Right. I don't know if you guys remember this year from second level, but this will be a lot simpler to deal with. Very much simpler to deal with. So this year would best be illustrated on the Z curve, yeah, which would this would best be illustrated on the Z curve. So here you have 100 being your autonomous consumption, and then this one, of course, is autonomous investment. So which means your starting point on the curve is going to be on your 100 plus 100, which is going to be your 200. That's going to be the intercept. Then your line going that way, and then you've got your gradient there, of course, which is your MPC, right? Your MPC, marginal propensity to consume, is going to be 0.8, right? So maybe just do check that out. Maybe with this one, you just need to have a look. You don't really have to draw it. I don't think you'd really forget this. It's very simple, that one. And then right equation of the saving function. They don't ask these anymore. I don't know why. So which is why they might ask it because they are not asking these anymore. Right. So obviously if you have this here, it's gonna be easy for you to do the savings function. Maybe just by remembering to convert the NPC, the marginal propensity to consume, to NPS, which is the marginal propensity to save, finding the difference there between that and one. All right. And then draw and explain a figure showing the equilibrium level of national income in terms of desired saving and investment. Right. I don't know why they were really concentrating so much on, or I mean, we're really asking these things that you'd expect to find on the second level, but it's still fine. Right. So in terms of now drawing and explaining a figure showing the equilibrium level of national income, we want to, let's see what we did now on this one here. Here we are just, okay, explain draw and explain a figure showing the equilibrium level of national income. So what we need to remember here again is to put in the line of equilibrium, which is that line, that 45-degree line. So of which you could as well again come back and do the same thing here. You could as well basically come and do the same thing here. So this is just 5 marks. This is just 5 marks. But let's see, we are showing the equilibrium level of national income in terms of the desired savings. So on this one here, I don't know if you guys remember how that function was derived, right? How that function was derived, where we're equating savings to investment, etc. That's basically what's being referred to here, but nothing much on this one, only 5 marks. My prediction is that maybe we could get something like that. But assuming what autonomous investment increases from that, draw a figure explaining the total expenditure showing the new level. Oh, there's a lot of drawing here, right? And then determine the value of the multiplier. So all of this is still second level, right? Then one of you did this question, by the way. Suppose a nation with an open economy and a fixed exchange rate is in short run equilibrium below its natural level of output. So in other words, in a recession, explain with the aid of a diagram using aggregate demand and aggregate supply curves how such a nation could attain simultaneous long run and short run equilibrium without any expansionary policy. Right. I can't remember who did this question, by the way.
I think I did it. I'm not totally sure.
Okay,
If in one of the past exam papers.
one of the past exam questions.
Yeah, because I
Maybe.
see the word in brackets in a recession. So that's how I'm able to see that I did it. Because I did papers from 2017 up until now this year. But I don't think it's gonna go that far back.
No, I doubt.
Because
I
the
doubt.
questions that they used
Mhm.
prior to 2020, they're not being
Mhm.
used uh, since it's not
Up.
in the recent papers. So I think that was a waste of
Mhm.
time.
Yeah.
Yeah.
If you look at
What
even
is
what's
you're
here,
also doing now?
yeah. If you look at especially what was on this one, most of that there is second level stuff.
Mm.
Okay, it's
So
fine. Let's see.
do we
Mm-hmm.
have to do this paper and give the answers in the next class, which is Thursday?
Ah, no, no, not this
Or
one.
are we just going through it? Okay, then it's
Yeah.
fine.
We're just perusing through here.
Yeah, I don't think she's gonna put like complicated stuff in because
I
she said
doubt as well. Mm.
she's considering like using questions that we have seen before because she doesn't wanna
Mm-hmm.
um let us fail because next year she wants other students in her class. Maybe she knows there's a lot of us that failed. She clearly stated on Thursday's team she doesn't want us in her class again next year.
No, but why? But why did she fail so much people last year?
Last semester, I don't know. I really don't know, my dear. She just said
Mm-hmm.
we should really go through assignment two's questions because
Yes.
the majority of them are going to be in there. And then she did other potential questions like the discussing the balance of
Mm-hmm.
payments and what you should
That one.
um, do in that answer. And then the covered interest arbitrage she also did. And
Oh, that
then
one. Okay.
yeah, the stable and unstable foreign exchange.
Mm-hmm.
Um,
Okay.
yeah, so you have to explain those two and then the graphs, obviously, because she said even though
Mhm.
the question says with this aid, you don't need graphs. But you do need to include the graphs, even though it says you don't have to, because how are you going to explain what is happening if there's no graph? So I think they try to trick us with that question saying not to include graphs, but how are you going to explain when there's no graph? So you have to draw the graphs. And that's actually how the students lost some questions he said
Mm.
previously and how they failed. But I think it's on her in that the majority of the students failed. Now she's putting emphasis on, I don't want you in my class the next semester, blah, 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 blah.
Yeah, it's on her end, yeah.
Other
It's
thing
on her
is,
end.
last semester she wasn't the head lecturer. The head lecturer was Mrs. Amusa, and she's quite strict.
Oh, yeah,
Musa
that's what
is a
I've
clown, I
noticed.
swear.
This one isn't that strict. She's much comfortable. She's not that strict.
Is it?